Welcome back to the Deep Dive. Today we are focusing our lens on a company that I think really embodies this collision of consumer tech and complex healthcare.
Absolutely. We're talking about HIMS and HERS Health,
Ah,
ticker HIMS.
And as we're doing this analysis, the stock is sitting at $33.41. That gives it a market cap of what, about $7.3 billion?
Yeah, roughly 7.3 billion as of today, January 12th, 2026. And, that price tells a story.
It really does.
For anyone who's been watching HIMS, you've seen a perfect example of Benjamin Graham's Mr. Market.
Oh, totally. The manic depressive personality.
Exactly. The market has just been whipping back and forth between, total euphoria over the demand for weight loss drugs.
The GLP-1s, right?
And then just crushing despair over this looming threat of FDA intervention.
It's financial whiplash. So our mission today is to just, ignore all that noise, ignore the voting machine.
And apply the Warren Buffett weighing machine lens.
Right, the weighing machine.
Yeah.
We need to figure out, once and for all, what is HIMS at its core?
Is it a real, durable consumer franchise? Does it have a genuine moat built on brand and data and all that?
Or is it just a temporary regulatory game? An arbitrage play that's just waiting to collapse once these drug shortages are officially over?
It's the ultimate test, really. Quality versus what could be a catastrophic risk. So we synthesized all the data, the financials, the legal stuff.
And what's the verdict up front?
Well, our intrinsic value estimate, it lands the stock somewhere in the range of $38 to $42 per share.
Okay, so that's just a pretty compelling opportunity. At the current price of $33.41, that's a potential margin of safety of, 15 to 20%?
It is, but, and this is a huge but, we can't overstate this, that entire projection hangs on one single condition.
Which is?
That the company can successfully and legally navigate this massive cloud of regulatory uncertainty that threatens to just dismantle its biggest growth engine.
So it's a story of explosive growth, but it's all subsidized by a high-stakes legal argument.
You've got it. That's the whole thesis in a nutshell.
Okay, let's dive in and start unpacking the nuts and bolts of the business. Part 1, Chapters 1 to 3. Business, Management, and Financials. Chapter 1, Business Understanding.
So when we look at HIMS, we immediately run into that fundamental identity crisis you mentioned.
Right. Is it a real healthcare company focused on clinical outcomes? Or is it basically a CPG, a consumer packaged goods company that just, happens to wear a white lab coat?
And the answer to that question really dictates everything. The sustainability of their margins, their long-term survival.
Yeah.
It all comes down to that.
The fate of the company and its ability to justify that, $7+ billion market cap, it really hinges on whether their latest pivot.
The personalization pivot.
Right, whether that pivot can actually insulate them now that the drug shortages that kind of fueled their rise are officially over.
So to define HIMS, I think we have to start with what they don't do, what they strategically avoid. They are not, and they have no interest in being a biotech or a traditional pharma company. They stay away from the incredibly high-risk, capital-intensive process of molecular discovery.
So they're not spending billions trying to find the next blockbuster drink.
Not at all. Their core value proposition isn't invention. It's not discovery. It's all about access, speed, and discretion.
We call it reinventing access, not discovery.
Right. The opportunity HIMS saw was just the sheer friction in the traditional healthcare model. I mean, think about it.
The stigma, for one.
The stigma around talking about things like erectile dysfunction or hair loss, the hassle of making an appointment, sitting in a waiting room, waiting in line at the pharmacy.
No price transparency.
Yes. None. HIMS just disintermediates that whole process. They cut out the middleman.
They built this telehealth native platform that just removes all that friction.
Correct. The consumer goes online, connects with the provider, they get a prescription, often for a generic or a custom compounded drug, and it's fulfilled by an affiliated pharmacy and shipped right to their door, discreetly.
So the drug itself, the sildenafil or whatever, that might be commodity. The value is the experience.
It's the premium experience and the efficiency. That's what you're paying for.
And that model has just completely transformed their revenue. I mean, looking at the 2026 landscape, it looks nothing like the early days.
Not even close. Back then, they were just known for sexual health stuff. Now, the company is really built on 4 distinct anchor verticals.
So let's start with the biggest one, the dominant engine.
That would be weight loss, the hypergrowth engine. This vertical has gone from basically a standing start to tracking toward an annualized run rate of around $725 million by the end of 2025.
That is just unprecedented growth for them.
And it was almost entirely fueled by the availability of compounded GLP-1s, right? Semaglutide, tirzepatide.
When you couldn't get Wegovy or Mounjaro because of the shortages.
It was pure rocket fuel for their business. But now we have the critical problem. The FDA declared those shortages resolved in late 2024, early 2025.
Which means, legally, HIMS can't compound them under that old shortage exemption anymore.
Correct. Which brings us to that crucial pivot you mentioned, the move toward personalized dosages.
This is their legal defense, basically.
Precisely. They've shifted their entire strategy, legally and operationally, to providing customized formulas. So this could be an oral compounded solution, or maybe specific injectable dosages that are titrated to what a patient can tolerate.
Or combining it with something like vitamin B6 to help with nausea.
Exactly, things like that. This whole pivot is their legal maneuver to stay in the weight loss game.
Okay, let's move to the bedrock of the company.
Sexual health. The cash cow. This is still a foundation. It's the high-margin revenue generator, mostly using generic sildenafil and tadalafil.
And this is what funds the high-stakes growth elsewhere.
Right, and the moat here is purely psychological. These drugs are commodities. You can get them cheaper elsewhere. But HIMS maintains a premium price.
Why?
Brand equity. Their target demo young men, they value the discretion and the trustworthy, recognizable HIMS brand far more than they value saving a few bucks with some unknown online supplier.
The brand makes them feel safe.
It validates the entire interaction. Then you've got the third vertical, which is often overlooked, but it's strategically vital.
Dermatology, HERS, the compounding prototype.
This is where HIMS really proved out the compounding model. Under the HERS brand, they offer these custom compounded creams. They mix things like tretinoin, azelaic acid.
Bespoke ratios for each patient.
Right. And critically, you cannot buy these personalized formulas off the shelf. You can't get them at a regular pharmacy.
And that creates high switching costs. Once you find a formula that works, you're kind of locked into the HIMS ecosystem.
Exactly. And that brings us to the fourth vertical, mental health. This is mostly common SSRIs and SNRIs.
And this is what you call an ecosystem retention play.
It's all about increasing customer lifetime value, the LTV, because conditions like anxiety and depression often have comorbidity with their other conditions, hair loss, ED, weight struggles.
So by offering it all on one platform, HIMS becomes stickier.
Right. It encourages users to stay on the platform for multiple long-term treatments.
So we have the four pillars. But if the value is just the experience, what stops Amazon from just replicating this whole thing? Where's the actual durable moat?
That's the key question. We've identified two critical layers to their moat, and they both align with what Buffett looks for.
Okay.
Layer one is brand equity. Buffett called it share of mind. If you're a 28-year-old guy and you notice your hair is thinning, your first instinct isn't to Google a local dermatologist.
You search for HIMS.
You search for HIMS. That brand association is incredibly powerful. It means they can bypass the really expensive fight for customer acquisition.
It lowers their CAC.
Significantly. It positions HIMS as the Amazon of health in the minds of that key demographic. It's a trusted shortcut.
And the second layer is the tech.
The second layer is data, specifically their proprietary system called MedMatch.
So what does MedMatch do?
MedMatch is more than just a scheduling tool. It's an institutional learning engine. It analyzes millions of patient interactions, prescriptions, outcomes, side effects.
All the data from their subscriber base?
All of it. It processes patient data age, weight, other conditions to predict the best starting dosage and formula for the next patient with a similar profile.
So how does that create a moat?
The moat is efficiency. In traditional medicine, finding the right drug and dose is often this long, painful process of trial and error.
Right.
On the HIMS platform, if a treatment fails, that data goes right back into MedMatch. It improves the predictive accuracy for the next person. So, theoretically, it reduces that trial and error period, increases the chance of early success, and that boosts retention.
And that proprietary feedback loop is something Amazon can't just build overnight.
Exactly. It's built on years of data.
Okay, now we have to address the elephant in the room. All this growth, this moat, it's all potentially for nothing because of the regulatory sword of Damocles.
This is the single biggest risk to the entire investment thesis. There's no way around it.
That's why the stock is so volatile.
Absolutely. The problem, as we said, started when the FDA officially declared the shortages for tirzepatide and semaglutide were over.
So for our listeners, let's break down exactly what that means under the law. We're talking about Section 503B of the Food, Drug, and Cosmetic Act.
This is so crucial to understand. Section 503B governs these things called outsourcing facilities, basically large-scale compounding pharmacies registered with the FDA.
Okay.
And under this section, they can only mass produce essential copies of an FDA-approved drug if that drug is on the official FDA drug shortage list.
And the second it's taken off that list.
The second it's off the list, that mass manufacturing becomes a violation of federal law. The entire business model built on that shortage becomes illegal.
So the loophole that powered that $725 million weight loss business has now legally been closed.
Which brings us back to their primary defense, the clinical necessity exception.
This is their lifeline.
It is. HIMS is arguing that they are no longer selling essential copies based on the shortage. Instead, they're arguing that their compounding is for a specific clinical need for an individual patient.
So give an example. How do they frame that clinical need?
It's all about customization. A standard Wegovy pen delivers a fixed dose. HIMS argues many patients can't tolerate that. They need a custom lower-strength dose to start, or they need the drug combined with something like B12 to handle the nausea.
And federal law allows that.
Federal law does permit compounding if a prescriber determines there's a specific clinical need for a customized formula, as long as it's not essentially a copy of what's already available.
This sounds like a pretty big legal gray area, and it seems like the FDA is not buying it.
They're definitely challenging it. We saw that in September 2025. The FDA sent warning letters that were very specific. They targeted HIMS for making false and misleading claims, especially any marketing language that implied their products were generic equivalents.
So the FDA is basically saying, we think you're just using this exception as a loophole for mass production.
That's the core of the conflict. The agency is asserting that even if you personalize it slightly, if you're doing it on an industrial scale, it might still be considered essentially a copy.
And if the FDA wins that legal argument, the weight loss segment just evaporates overnight.
Instantly. It's a binary risk.
Okay, let's quickly touch on the competitive landscape. You mentioned Amazon Pharmacy, the 800-pound gorilla.
Amazon's threat is all about price and efficiency. They can sell you generic finasteride for, say, $16 a month. HIMS charges around $22. For the consumer who only cares about price, Amazon wins.
But HIMS is betting on the brand experience.
They're betting that people will pay a premium for the curated experience, the doctor, the consultation, the discreet branded box. Amazon just delivers the box.
Then you have Roe, or Roman.
They're the direct competitor, almost an identical model. They basically mirror HIMS's pricing and product launches. It's a duopoly, really.
And finally, the big guys, traditional pharma.
Novo Nordisk and Eli Lilly. They see compounders like HIMS as a direct threat to their intellectual property and their profits. They are aggressively pursuing legal action and lobbying the FDA to shut this down.
So HIMS is fighting a war on multiple fronts.
It's an incredibly complex picture. The moat is brand and data, but the growth engine is running on a legal defense that's being attacked from all sides.
A true high-risk, high-reward proposition.
Definitely.
Like and subscribe to the Stock Analytics AI YouTube channel for deep dives into these regulatory frameworks. I mean, truly understanding Section 503B and the whole clinical necessity argument is where the real edge in this trade is. Chapter 2, Management Evaluation.
Chapter 2, Management Evaluation. In a situation like this with so much regulatory risk, the quality of the management team it's just paramount. We have to apply that Buffett lens. Are they rational? Are they acting like owners?
Absolutely. And when you look at Andrew Dudum, the CEO, and his team, the word that comes to mind is adaptability. They've pulled off two huge existential pivots that basically saved the company.
The first one was moving away from simple dropshipping.
Right. They moved into vertical integration and compounding.
Yeah. They realized super early that just being a middleman connecting doctors to pharmacies, there's no moat in that. Margins get crushed. So they proactively acquired compacting facilities.
Like Apostrophe for dermatology and, crucially, Metasource Rex.
That Metasource Rex acquisition was so critical. It's a registered 503B outsourcing facility.
So it gave them control over the supply chain.
Total control, which is key for quality and for rapid innovation. They could suddenly create their own unique products, like the chewable ED mints that competitors couldn't just copy. It secured their margins and their product pipeline.
And the second big pivot was the GLP-1 strategy.
Right.
Where, people were criticizing them for being late to the party.
And that delay turned out to be brilliant. It was so prudent. While everyone else was rushing in, they were dealing with quality control issues, unreliable supply.
Right.
HIMS management waited. They waited until they could lock down a reliable, high-quality supply chain and what they believed was a compliant 503B path. They prioritize long-term survival over a short-term revenue grab.
Their response to that FDA warning letter in September 2025 also says a lot.
It really does. The market freaked out, the stock dropped 10–12%. But instead of fighting a big, ego-driven legal battle over marketing words,
They just complied?
they responded swiftly. They scrubbed all the language about generic equivalents and refocused everything on personalized clinical need. It shows they're pragmatic, they're focused on survival, not on winning an argument.
Okay, let's talk capital allocation. This is the true test of management. They've been very active with M&A.
And they've shown excellent judgment. The acquisition of Xavier in 2025 was a masterstroke. It was both offense and defense.
Xavi is a big European telehealth player.
A huge one. It gave HIMS immediate scaled access to the UK, Germany, France, Ireland. We're talking about a market of 200 million adults.
But why was that so crucial right now?
Because it's a geographic hedge, it's a massive hedge against the concentration risk they have with the US FDA. If things go south in the US, they still have this huge international growth runway governed by different regulators.
It diversifies the entire risk profile.
Exactly. And then they doubled down on supply chain control with the CS Biopeptide Facility acquisition.
This signals they want to make the ingredients themselves.
It's an ambitious play to own the manufacturing of the active pharmaceutical ingredients, the APIs. So much of the world's API comes from China, which exposes you to tariffs, supply shocks, geopolitical risk.
So bringing that capability in-house is a long-term move to mitigate that risk.
It's a strategic countermeasure. It will take time and money to scale up, but it builds resilience and protects their future gross margins. It's long-term thinking.
And finally, the signal that investors love to see, the share buyback.
In late 2025, the board authorized a huge $250 million share repurchase program. This is management putting the company's money where their mouth is.
By buying back stock around the $30 level, they're sending a clear message.
They're explicitly saying to the market, we believe our stock is undervalued at this price. It's a powerful signal of conviction.
Okay, but we have to balance that against insider incentives. The corporation is buying, but we've also seen executives selling.
And that's the conflicting signal we have to watch. While the CEO, Andrew Dudum, has control through his supervoting shares, we do see regular stock sales. Like the COO, Michael Chi, sold about 13,750 shares at almost $37 in December 2025.
As a value investor, why isn't that a huge red flag?
It's a yellow flag for sure. You're right. Value investors always want to see management buying shares at these low points, not selling, even if they are pre-planned 10b5-1 sales.
So how do you weigh the two?
I think you have to weigh the corporate action more heavily. The $250 million buyback is a far more material commitment of capital than an individual executive's diversification sale. But you can't ignore the sales. It's something to monitor constantly.
Chapter 3, Financial Health.
Financial health. Okay, so we had the narrative, smart management, big risks. Now we have to see if the numbers, the weighing machine, actually support it. And we have to start with growth. It's been phenomenal.
I mean, the numbers really confirm they have massive product market fit. A compound annual growth rate over 50% for 5 years. That's hyper-growth territory.
Let's put some specific numbers on that. Revenue went from $148 million in 2020
Okay.
to $527 million in 2022, and then hit $1.48 billion in 2024. But the projection for 2025 is the real shocker. They're guiding for $2.3 to $2.4 billion.
And that huge jump is almost all coming from the weight loss category. The data shows that segment just exploding to an estimated $725 million in 2025. It's become a co-dominant force with sexual health.
But growth isn't everything. The quality test is in the margins. Historically, HIMS had these software-like gross margins well over 80%.
But we've seen those come down a bit.
We have. They compressed to 74% in Q3 2025, and we need to be clear why. This isn't because the business is getting worse.
It's the product mix.
It's the product mix. The GLP-1 business involves sterile injectables, which have a much higher cost of goods sold, or QGS, than just pressing generic pills. It's an unavoidable trade-off. You get explosive revenue, but at a slightly lower gross margin.
But the key here is that 74% is still an exceptionally high gross margin for any kind of healthcare company.
It's fantastic. And it gives them incredible room for operating leverage as they scale. It's a sign of a high-quality franchise.
And that leverage helped them cross a huge milestone, GAAP profitability in 2024. They posted a $126 million profit.
That was the moment they proved they weren't just a growth-at-all-costs company, but And this is important for investors. We have to apply a normalization filter here.
Explain that. Why do we need to normalize the recent earnings?
Because the raw numbers can be misleading. In Q3 2025, net income was $15.8 million. But in Q3 2024, it was reported way higher at $75.6 million.
So it looks like profitability crash.
It looks that way, but the 2024 number was inflated by a one-time $60.8 million tax benefit. You have to strip that out to see the real underlying operating profit, which has been steadily improving.
Okay, let's move to free cash flow, the ultimate truth.
This is what Buffett looks for. And their FCF is strong and consistent. They generated $209 million in 2024 and kept that pace with $198 million over the trailing 12 months through September 2025.
And that positive cash flow makes them so much more resilient than unprofitable tech companies.
Infinitely more. They're not reliant on capital markets. Which brings us to CapEx. Their capital expenditures, they've been rising a lot.
Yeah, from $17 million in 2023 up to a range of $41 to $65 million. That's usually a red flag.
Usually. But here we have to distinguish between good CapEx and bad CapEx, and this is all good CapEx.
How so?
It's not maintenance spending just to keep the lights on. This is growth CapEx. It's all being invested directly into deepening the moat.
So they're building out those compounding facilities.
Exactly. Expanding Metasource RX, integrating the CS Bio facility. Every dollar spent there secures their vertical integration, expands their capacity, and protects them from those supply chain risks we talked about.
So it's an investment in the defensibility of the business.
Precisely. It's management acting like owners, using cash flow to build a stronger foundation. And their balance sheet just reinforces that strength.
Let's see it.
Super robust. As of Q3 2025, they've got $165 million in cash, and here's the key: negligible long-term debt. That gives them maximum flexibility to handle whatever comes their way.
Okay, so if the financials are the strong, great growth, high margins, clean balance sheet, positive cash flow, why is the stock so controversial? Why is the PE ratio so high?
And that takes us right to valuation. On the surface, it's a sticker shock. Based on the 2025 EPS estimate of $0.48, the price-to-earnings ratio is around 69 times. Looks crazy expensive.
But you can't look at PE in a vacuum for a growth company.
You can't. You have to use the PEG ratio, the PE to growth, and when you do that, the story completely changes. With growth projected at 35 to 50%, the PEG ratio is between 1.5 and 2.0.
Which puts it in the growth at a reasonable price, or GRP category.
Comfortably. It shows the market is paying a premium for growth, but not an insane one.
So let's quantify all this uncertainty with the DCF, the discounted cash flow model.
The DCF matrix really shows you the risk discount the market is applying. Our bear case, which assumes the FDA cracks down hard and growth slows to 15%, that gives you an intrinsic value of $28 to $30.
Right, where the stock was trading at its most fearful point. What about the bull case?
The bull case assumes they navigate the regulations, Zia Via works out, and they maintain 20+% growth. That pushes the value way up into the $45 to $50 range.
So the current price, around $33, is really pricing in a middle ground. It's expecting them to survive, but it's applying a huge discount for the possibility that they don't.
That's it, exactly.
We've now dissected the core business, management, and financials. It's a high-quality company, but it's operating in a really volatile regulatory world.
Apologies to all members. We have been demonetized by YouTube for repetitive content. They clearly don't understand what we're doing here. The good news is that we're going to continue. For members, sign up at stockanalytics.ai, and within the next few weeks, we will upload access to the full 600 videos for the S&P 500 and NASDAQ 100, and the coming 100 top AI stocks of 2025, $5 per month, and we will begin adding more features to the web application by the week, so joining early will be a great advantage.
We appreciate your patience with that. Now that we have the financial scaffolding in place, let's pivot to market sentiment and the full spectrum of risk. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
Chapter 4, Market Sentiment. Okay, so if the last chapter was the weighing machine, now we're checking in with Graham's voting machine. How is the public reacting to all this?
And it seems like the sentiment is just deeply polarized. It's a classic battleground style.
It is. Wall Street is completely split down the middle. It perfectly reflects how different analysts are weighing that FDA risk.
So let's start with the bulls. Who are they, and what's their argument for a much higher valuation?
The bullish firms like Evercore ISI and Jefferies have price targets up in the high 40, low $50. Their thesis is that the market is just severely underestimating the brand's durability,
The stickiness.
the user stickiness from MedMatch and the compounding. They're also saying the European expansion through Zavia is being undervalued and that it's a clear offset to the U.S. regulatory risk.
So the bulls think the moat is strong enough. What about the bears?
The skepticism is all about that regulatory kill switch. BofA Securities has an underperform rating, a price target near $29. They just don't believe that $725 million weight loss run rate is achievable if the FDA curtails the compounding business.
They see a material contraction coming.
They do, and the
Okay.
technicals show this tug of war perfectly. The short interest is really high, which basically turns the stock into a loaded spring.
Right. Any good news could cause a massive short squeeze.
A massive one. Any positive regulatory news could send the stock flying. Right now, technically, it's consolidating. It's trading below its 50-day moving average, which shows short-term weakness, but it keeps finding support near the long-term 200-day moving average.
Which suggests big institutional money is stepping in to buy at these levels.
That's what it looks like.
Chapter 5. Ownership structure.
Chapter 5, ownership structure. Looking at who owns the stock, the smart money, can give you real insight into conviction levels.
So who's holding HIMS now?
Well, the ownership base has matured a lot. It started with VCs, but now it's held by the biggest asset managers in the world. Vanguard, BlackRock, State Street. That's a huge degree of institutional validation.
But the really interesting signals come from the hedge funds, right? The active managers.
That's where it gets fascinating. You have two completely different types of smart money moving in at the same time. You've got Renaissance Technologies, Rentech, which is a pure quant momentum-based shop.
Right.
And at the same time, you have Farallon Capital, which is a deep fundamental value shop.
So the quants and the value guys are both buying. That's a powerful signal.
It's a very powerful indicator. One sees the technical setup and momentum. The other sees the discounted intrinsic value. It means the thesis appeals across different investment styles.
But we have to come back to the insider activity one last time. We have the big corporate buyback, which is bullish, but the executive selling.
And it's something you just have to watch constantly. We continue to see steady sales from founders and executives, like that COO sale in December 2025. Even if they're planned sales, it prevents you from saying management has supreme conviction at these prices.
You'd want to see them buying.
Ideally, for true conviction, you'd want to see significant insider buying right in the middle of all this volatility.
Chapter 6.
Risk assessment.
Chapter 6. Risk assessment. Okay, let's focus on the threats. Preservation of capital first. We'll do a full SWOT analysis, starting with the internal factors.
So the strengths are pretty clear. They are brand loyalty. They basically own the digital men's health space, the data moat with MedMatch, and that vertical integration through their facilities.
And the weaknesses are just as clear.
The big one is low R&D spend. Their model is all about repackaging existing drugs, not discovering new ones. And telehealth models inherently have high customer churn compared to, say, enterprise software.
Now for the external factors, the opportunities seem dominated by that international play.
The ZIV acquisition is a huge runway. It opens up that 200 million person European market, which is so important for diversifying risk. And they've shown incredible pricing power, maintaining premium prices even with Amazon undercutting them.
Okay, now to the threats, the macro kill switch. Let's really drill down on this regulatory threat.
It's the highest risk, period. If the FDA successfully argues that clinical necessity isn't genuinely individualized, but just a loophole for mass manufacturing,
The 503B operations could be shut down instantly.
And the immediate result is that the majority of that $725 million weight loss revenue stream vanishes. Gone.
So we have to understand, this clinical necessity defense is not a sure thing. It's a legal battle.
It's entirely untested at this scale against the FDA. The regulator's argument is, does this customization truly require a deviation from the standard drug, or is it just a convenience? The whole case rests on HIMS's ability to document and justify that need for every single patient.
Beyond the FDA, we have the macroeconomic threats, like tariffs.
The 25% tariff on Chinese imports, where a lot of APIs come from, is a direct hit to profitability. It would increase their cost of goods sold and compress those 74% gross margins.
Which highlights just how strategic that CS Bio acquisition was.
It's their long-term countermeasure to onshore that capability, but it's a long project. It won't protect them from the immediate margin pressure in 2026.
And what about interest rates? High rates usually crush growth stocks.
They do, and it pressures the valuation multiple. But HIMS is pretty anti-fragile here compared to other growth companies because they have positive free cash flow. They're self-funding their growth. They don't need to borrow money or sell stock.
So to really visualize this, let's map the supply chain. It's become a regulatory maze.
Okay, so it starts at the API source, which is often China, so you have import and tariff risk. That material then moves to HIMS's facilities like CS Bio and Metasourcer X.
And this is the regulatory choke point.
This is it. The Section 503B compounding stage, which is under constant FDA regulation risk, the product then goes through the MedMatch AI system to the provider network. And the final highest risk step is the provider asserting that clinical necessity.
And that one legal gateway, clinical necessity, has completely replaced the old shortage exemption.
Yes. That entire multi-billion-dollar weight loss business now flows through that single, untested legal argument.
So you're not just investing in a company, you're investing in the future interpretation of federal law.
That's the trade.
Chapter 7. Conclusion. All right, time to synthesize these two conflicting stories and give a final verdict. Let's start with the bull case, the compounding narrative.
The optimistic view. The bull case says HIMS is a true next-gen consumer health franchise. They successfully navigated the post-shortage world with legitimate personalization that the FDA will manage, not kill.
And if that's true, it's a high-quality company.
It's a high-quality compounder, dominant brand, pricing power, a huge international runway, and the valuation is compelling. A PEG ratio under 1.5 with strong free cash flow is very attractive.
Okay, now the flip side, the sobering view, the House of Cards narrative.
The bear case says HIMS is living on borrowed time. The FDA will close the loophole, decapitating the weight loss business. At the same time, Amazon will erode margins on their core business, and tariffs will compress profitability further.
In this view, the stock is a classic value trap.
Exactly. It's cheap for very good reason.
So bringing it all back to the numbers we started with, what's our final valuation?
After weighing everything, we are sticking with our intrinsic value range of $38 to $42 per share. This is what we believe the company is worth if the regulatory outcome is bad, but not catastrophic.
And with the current price at $33.41, that gives us a margin of safety of about 15 to 20%.
It does. We classify HIMS as a quality at a reasonable price, or QARP play. It has all the franchise qualities, but it also has this undeniable binary regulatory risk that a truly conservative investor would just avoid.
So the margin of safety is based on the probability of survival, not guaranteed safety.
That's a perfect way to put it.
So what is the final essential takeaway for the enterprising investor listening to this?
The market is currently pricing in a very high probability of catastrophic regulatory failure. So the key takeaway for you is the idea of asymmetric upside.
Explain that.
If the FDA outcome is just a manageable headache, a fine, some marketing changes, maybe a small price increase, if it's not a catastrophic fatality that shuts them down, then the stock is so discounted that it is poised to re-rate much, much higher, potentially into that $45, $50 bull case range.
You're betting that the market has overpriced the risk.
That's the bet you're making.
A fascinating and incredibly detailed deep dive. Hims and Hers Health, a company that truly sits right at that intersection of consumer demand and regulatory uncertainty. Thanks for walking us through that maze.
Like and subscribe to Stock Analytics AI.
Remember, members can add stock suggestions for future videos in the comments. Join up for access to the full library of S&P 500 stocks and the growing NASDAQ 100 library.
Disclaimer. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.